Okay, so let's look at another example of the replacement project capital budgeting cash flows. I know it's a lot. That's why we're doing another example. The one thing to keep in mind always when we're dealing with a replacement project is to remember which of the two assets or investments we're talking about. Because remember, replacement project, we're selling one and buying one to replace it. So there are two things going on here, and it's important to keep in mind which we're dealing with. Okay, I have another example. I'm going to share the handout with you and we'll work our way through it. Okay, replacement project. Sell an old one, buy a new one. Durst equipment. Considering replacement, there's the magic word replacement of a grinding machine. Right. Everything else in this first paragraph is about the old machine we're getting rid of. The old machine was purchased 5 years ago and it cost 100,000. That was the depreciable base. It has remaining use of 5 years being depreciated by 10,000 a year. And they expect to sell it today for 65,000. So let's think about that for a second. They bought the machine 5 years ago. They paid 100,000 for it, and they've now been depreciating it for 5 years. I bought it 5 years ago, so 5 years of depreciation, and the depreciation is 10,000 a year. So how much have they depreciated? Well, 10,000 a year for 5 years, 50,000. Okay. And they expect to sell it today for 65,000. Okay. Now, what about the new one? Well, the new one they expect to cost 150,000 including installation. At the end of its 4 year useful life, there's the magic words. 4 year useful life. At the end of 4 years, it will be sold for 10,000, they expect. They're depreciating at MACRS, and they're using a 3 year recovery period. So MACRS 3 year, and as we know, MACRS 3 year gives you 4 years of depreciation because of that half year or mid-year convention. All right. So they expect the change will reduce their expenses 50,000. That's a decrease in an expense, so we add it. And it's expected to have no effect on revenues. So the change in revenues is zero. Does that mean revenues are zero? No, it means the change in revenues is zero. Right? Their tax rate, their effective tax rate is 34%, and the cost of capital is 15% should they replace the machine. How are we going to make that decision? Replace the machine. Well, we're going to use the discounted cash flow method, right? Expected future cash flows, investors' required rate of return, NPV, IRR. Right? So let's work our way through those expected future cash flows for a replacement project. All right? We're going to use MACRS. Here's the table. We're going to use the 3 year column. And here is our table for the initial cash flow. Remember, the first six have to do with the new machine. The next three have to do with the old machine. Be sure and keep this straight in your head. Right? Okay, so they expect to buy the new machine for 150,000, and we know that that includes the installation. But there's no mention of anything else, including net working capital. No mention of that. Right? So we just have to take those all as zero. So the cost of buying the new machine to get it all ready is 150,000. That's cash going out, so we subtract it. Right? What about the old one they're getting rid of? Well, they expect to sell it for 65,000. Right? And that's there. 65,000 cash coming in, so we add it. Now, what is the tax effect of that 65,000? Well, I've said it over and over again. I'll say it one more time. Tax on sale will always have three parts. Always, always. Right? And this tax on sale is tax on sale of the old asset. What about tax on sale of the new one? We'll get there. We'll get there. Right now, we're just dealing with selling the old one and recognizing the tax effect. All right, three parts. First part, what is the book value? Well, the book value is always the depreciable base minus all of the depreciation we've taken up to that point. Right, for the old machine, the depreciable base was 100,000. If you look back in the problem, it says 100,000 depreciable base. They've had it for 5 years, so they've been depreciating it for 5 years, and the annual depreciation is 10,000. Pardon me. So they've been depreciating 10,000 a year for 5 years. That's 50,000. So our depreciable base is the 100,000. Excuse me, our book value, sorry, is the 100,000 depreciable base minus 50,000 in depreciation. That gives us a book value of 50,000. All right, is it a gain or a loss? Well, it's worth writing, I think, that if the sale price is greater than the book value, it is a gain. On the other hand, if the sale price is less than the book value, it is a loss. So in this case, they expect to sell it for 65 with a book value of 50. So the sale price is greater than the book value. We have a gain. And the amount of the gain is the difference between the sale price and the book value. In this case, 15,000 gain. Step 3 is to figure the taxes. And we always figure the tax on the amount of the gain or the loss. In this case, the gain is 15,000. The effective tax rate is 34%. So that's the tax effect is $5,100. But the big question is, should we add or subtract? Well, if we sell it for a gain, then taxes are subtracted. Right? If they sell it for a gain, they have to pay taxes on that gain. That's an increase in their taxes, so we subtract it. If, on the other hand, they sell it for a loss, then taxes are added. If they sell it for a loss, that means they pay less taxes because of the loss. That's a decrease in their expense, so it gets added. Right? In this case, it was a gain, so we have to subtract the taxes. That 5,100 is subtracted, and there it is, subtracted. There was no mention of any net working capital, so that's a 0. Put all of that together, minus 150 plus 65,000 minus 5,100, our net initial cash flow is negative 90,100. And that goes down here on our timeline, sorry, negative 90,100. Okay, operating cash flow. Sorry. Don't mean to make you seasick. Operating cash flow. Well, we talked about a minute ago how that the statement is that at the end of its useful life, it will be sold after 4 years. That's what we're looking for, not the MACRS. In this case, they expect to sell it after 4 years. So there are 4 operating cash flows. Don't look at MACRS to tell you how many operating cash flows. Look for a statement about useful life, or it will be sold after, or that kind of thing. All right. So, pardon me, 4 years. They expect no change in revenues. So the change in revenue is 0. Does that mean that total revenue is 0? No, of course not. It means that there's no change. The increment is 0, and that's what belongs here. They also expect reduced expenses of 50,000 a year. When expenses decrease, we add it. So add 50,000. Right? And that brings us to depreciation. Right? We were depreciating the old machine at $10,000 a year. I'm going to color it yellow for the old machine. Well, when we get rid of the old machine, we stop that depreciation, and that's a saving. Right? You can't depreciate something you don't own. That stops that depreciation. That's a saving. That's a decrease in an expense. So we add it. But of course, at the same time, we replace the machine, and therefore we replace the depreciation with the depreciation of the new machine we're bringing on board. Okay. Now, the new machine said they're going to depreciate using 3-year MACRS. Well, if you look at the MACRS table, you'll see, of course, that 3-year MACRS gives us 4 years of depreciation because of that half-year or mid-year convention. And here are the percentages from that table. 33, 45, 15, and 7, and those 4 add up to 100%. All right? What do those amounts apply to? Well, they apply to the depreciable base. And now we're dealing with the new machine. So it's really important to keep in mind that this is the depreciable base of the new asset. Pardon me. Earlier, we dealt with the depreciable base of the old one. Now this is the new one. Excuse me. All right, and that depreciable base is just 150,000. If we go back up to the initial cash flow, I beg your pardon, it's the first 4. Down to training, but not including it. Right, so the first 4, 150,000, 000. So our depreciable base is 150,000. Right, and there it is. So we apply each of these percentages to the depreciable base. 33% of 150,000 is 49.5. 45% of 150,000 is 67.5, and so on and so on. And there are our depreciated amounts. Add those 4 up, by the way, and you get 150,000. So we put those 4 numbers in here as the new depreciation, and we subtract them. Right? We bring in the new machine. That's an increase in depreciation, an increase in an expense. So we subtract it. All right. Put those two things together to find the change in depreciation. Plus 10,000 minus 49,000 is minus 39.5. Plus 10,000 minus 67.5 is 57.5 negative, and so on and so on. And then we will not use the new and the old again. Right? We will not use that new and old again. Okay, that brings us to the change in EBT. That's just the sum of the change in revenue, change in expense, change in depreciation. Right, next step is the taxes. The tax is 34%. 34% of what? Well, of the EBT directly above it. Right, and now it's maybe worth writing down that if change in EBT, T is positive, then change in tax is subtracted. And if change in EBT is negative, then change in tax is added. I know that seems weird to add tax, but we're not adding tax, we're adding the change in tax. Right? Tax is an expense. If it's added, that means that expense decreased. If it's subtracted, it means that expense increased. Keep that in mind. Right? First year, EBT is positive, taxes are negative. Second year, EBT is negative, taxes are positive, and so on. Right? Just don't fall into that trap of thinking, well, the earnings are negative, so they didn't pay taxes. No, the earnings decreased, so they paid less tax. Okay, put the EBT and the taxes together, you get EAT, earnings after taxes. Then, of course, we undo the change, not the old, not the new, but the change in depreciation. Right? It was negative 39.5, so it's positive 39.5, and so on. Put those two together and we get the operating cash flows. And those go down here on the timeline for the operating cash flows. All right, that then leaves us with the terminal cash flow. Time 4, it happens at the same time as the last operating cash flow. And this is now all about getting rid of that new machine. Not so new anymore because this is 4 years later, but getting rid of that new machine. So selling the new machine, they expect to sell it from 10,000. It's 4 years in the future, so we don't know for certain, but that's what we expect, 10,000. All right, cash flowing in, we add it. Next, tax on sale. And this is the tax on the sale of the new one. We already did tax on the sale of the old one. Now this is tax on the sale of the new one. Right? So this is tax on the sale of the new machine. We'll have 3 parts, just like always, 3 parts, always, always, always. And the book value is always the depreciable base minus the total of all the depreciation we've taken. Right? This case, you go back to the initial cash flow, you look at those first 4 items. For the new machine, you find it's 150,000. It was 150,000 plus 0 plus 0 plus 0, 150,000. Then you look in the operating cash flows in that row that says new depreciation. And here they are, 49.5, 67.5, 22.5, 10.5. Add that depreciation up and you get 150,000. So our book value is 0. We paid 150,000. We've depreciated 150,000. Book value is 0. That's not market price. That's not selling price. That's book value, right? Depreciable base minus all the depreciation. And what that tells us is that we've completely depreciated that machine. Does that mean we have to get rid of it right away? No, it doesn't mean that at all. We could keep it for years. Right? In this case, we are getting rid of it, but not because we have to. Okay, so the book value is 0. But we expect to be able to sell it for 10,000. Hot dog, it's not, our books say it's worth nothing, but we can sell it for 10. Well, that's obviously a gain. The sell price is 10. The book value is 0. The selling price is greater than the book value. That's a gain, right? A gain of the entire 10,000 is a gain. Of course, we figure the taxes against that gain or based on that gain, 34% of 10,000, 3,400. Excuse me. Our tax effect, the tax on sale is 3,400. And since we're selling it for a gain, that means we have to pay additional taxes. That's an increase in an expense, so we subtract it. Right? Remember earlier we said if you sell it for a gain, then taxes get subtracted. And that's what we do. Right back here. There it is. There's the 3,400 and it's subtracted. Right? There was no investment in net working capital, so there's nothing to recover. 0 and 0, done. Put all of that together. Our net terminal cash flow is 6,600 positive inflow. And you see that here on the timeline. The final operating cash flow and the terminal happen at the same time. Put those together to get 39,770. Right? There's our timeline. There are our cash flows. I don't have it here. It was way back at the beginning. Sorry to scroll back up. Don't mean to make you seasick. WACC is 15%. All right, so back here now. Using that 15%, we find the net present value of these cash flows at 15% is 37,240.37. That, of course, is greater than 0. That tells me that value is greater than price. So we invest. We take the next step and find the IRR. The IRR is 35.17%. That's greater than our WACC of 15%. That tells me that expected return is greater than required return. And that tells me we should invest. Oops. So the last question, should the Durst Company replace the old machine? Yes. Why? Because the NPV is greater than 0. Well, so what? Well, that tells me that value is greater than price, so we should invest. And taking it even further, the IRR is greater than the WACC. Again, so, well, that tells me that expected return is greater than required return, so we should invest. Okay. So all of this, capital budgeting stuff up to this point has now gotten us through the 3 steps of the discounted cash flow. WACC is the required rate of return. We have the pattern or the template to find the cash flows for either an expansion or a replacement project. And we know how to put those together to find the NPV and the IRR and make a decision. The next step is to recognize that all of this is a forecast, especially the expected future cash flows. All of that's forecast, expected. And so that means that there's some risk involved. And remember that risk is the possibility that what you get and what you expect are different. And that could potentially have an effect on our decision. All right, we're going to take that up next time. Now, I know that this is a lot and it's been broken up into pieces. So what I want to do next time is take an example and work it through from beginning to end. Do all 3 pieces of the discounted cash flow for one capital budgeting project to see how it all fits together. And then we're going to push it a little bit farther and look at the risk involved. Okay? Now, as always, if you have any questions or any problems, be sure and let me know. I'll do my best to help and I'll get back as soon as I can. Okay, thanks.